Hello there, I hope that you are doing well. Welcome to this new lecture. This lecture is a follow-up on the information that I shared during my appearance on the Words of Wisdom podcast. During the podcast, I gave as my main advice to you the following. I shared with you that every single retracement followed by an expansion is a lower time frame market maker model. I shared with you that I want you to study this. During this lecture, I will discuss the topics of market maker models and their relationship with time cycles. Enjoy. The table of contents for this lecture are as follows. First of all, we're going to take a look at market maker models, better known as MMXM. Secondly, we're going to take a look at the quote, every retracement followed by an expansion is a lower time frame MMXM. Thirdly, we're going to take a look at implementing time cycles with MMXM. And finally, we're going to take a look at the application of time and MMXM. Let's begin with today's lecture. It's going to be a long one, so I hope that you're well prepared. Please watch this lecture in a quiet environment. I'm telling you that if you would watch and study what I'm about to share during this lecture, your perception about the markets will completely change and elevate to a new level of understanding. Get your notebooks out and don't be lazy. Let's begin. So first of all, we're going to take a look at a simple schematic of the market maker buy model. You might be thinking, yo Zeus, I've seen this schematic so many times, why are you showing this again? Because without a proper understanding of what this schematic represents, you will not be able to understand what I'm about to share during this lecture. Therefore, I need to refer back to it and make sure that the foundation in your understanding is proper. So to begin with the market maker model explanation, we're going to take a look at the market maker buy model first. As you can see, we have an original consolidation up here, showcased by this green box. What occurs in here is the following. The market is consolidating. It's engineering buy-side liquidity above these highs. The reason why it's buy-side liquidity that's being engineered is because retail-minded traders will look at this move lower through the following perspective. They will think, well, the market failed to break through this price level here, so therefore it's a strong resistance area. We can place our stop losses above these highs if we decide to go short. In order to get out of a sell position, you need to buy the market. And therefore, the liquidity that gets engineered above these relatively equal highs is called buy-side liquidity. The market then expands lower, and it retraces and expands lower. This whole leg lower right here, where we see expansions followed by retracements followed by expansions, is what we called the sell side of the curve. This sell side of the curve lasts until the market reaches a very specific POI, our point of interest. This is where our smart money reversal takes place. From the moment that our smart money reversal takes place, the sell side delivery, meaning the market was drawn towards sell side liquidity, turns into buy side delivery, where the market is now drawn towards all of the buy side liquidity that has been engineered above all the highs on this sell side of the curve. This lasts until the market trades above these relatively equal highs, where buy side liquidity is resting. This is our market maker buy model completed. If we then take a look at the market maker sell model, it looks like the following. It's completely the opposite when it comes to the logic of the market maker buy model. What we can see in the market maker sell model first of all is that there's an original consolidation down here. What this consolidation is doing is the following. It is engineering the idea of a strong support zone, so to say, being in right here. The moment that the market expands away from that consolidation, retail-minded traders will look at that through the following lens. They will think that the market found strong support here, so they will try to buy the market with a stop loss below these lows right here. The market continues to expand higher, it delivers higher, it's drawn towards buy-side liquidity, therefore this is called the buy side of the curve. This buy-side delivery takes place until the market reaches that point of interest, that POI. This is where our smart money reversal takes place. The moment that our smart money reversal is confirmed, we can anticipate the market to draw lower, drawing towards sales liquidity that has been engineered below all of the lows on the left side of the curve, on the buy side of the curve. Now let's think for a moment about why it's called sell side of the curve. Because the market is drawn towards sell side liquidity, and sell side liquidity rests below all the lows. And the reason why it rests below all the lows is because in order to get out of a buy position, you need to sell. And therefore, it's called sell side liquidity. The liquidity is on the sell side. Below each low, retail-minded traders will place their stop losses of their buy positions because they see this run higher and they think we're going to the moon, we're gonna fly higher, everyone needs to buy this, else I'm missing out. So they place their stop losses below all of those lows, and eventually we know that the majority of those traders will be wrong and caught off guard, and therefore we can anticipate the market to roll over, drawing towards these relatively equal lows here. Please note that this explanation of market maker models is just to make sure that the foundation is straight. There's way more to market maker models that I will discuss during this lecture. However, this is all I wanted to share when it comes to the foundation of the market maker models. If you want to study more about market maker models before continuing with this lecture, I would highly advise you to check out my educational playlist on my public YouTube channel. Let us take a look at the quote that was shared during the podcast. Every retracement followed by an expansion is a lower time frame market maker model. You might be wondering, what does that exactly mean? What does this look like? I understand that if you're completely new to trading and if you're completely new to ICT concepts in general, that such a quote can be rather confusing. You might not be able to imagine it in your mind. And that's why I've decided to create some schematics to make it easier for you to visually understand it. Because if you understand what I'm about to share in terms of schematics, please take screenshots of them, by the way. You'll be able to say, inside of this market move, there was a market maker model. And what do we know? When there's a market maker model present, there's an opportunity present. Here you can see the delivery that was showcased earlier during this lecture, during the introduction. I want to take your focus to the gray box. As you can see, the market expands higher right here. It then retraces with these two down close candles. What I want you to understand is that inside of this retracement leg, buy-side liquidity is being engineered, because there are retail-minded traders that will look at this retracement leg and think that the market will now roll over. So they will go short and they will place their stop losses above all of the highs that form inside of this leg lower on the lower time frames. What we know, however, is that the market is drawn towards a price level above the current market price. Therefore, we are anticipating a low to form. This is our lower time frame smart money reversal to then continue towards the upside and draw towards all of the buy side liquidity that was engineered during this leg lower. Inside of this delivery right here, you can see this delivery on the lower time frame occur. The original consolidation itself might not be as clean always. It's possible that the original consolidation itself might consist of even a few candles. However, if you understand what I just described to you, where we are drawn towards a level above the current market price, we know that this leg lower is engineering buy-side liquidity. And therefore, we can anticipate those higher prices to come if everything is aligned, what I'm about to share with you. Please take a screenshot of this chart because it's very important to understand. Once you understand that a retracement followed by an expansion in the opposing direction of that retracement, where the retracement was lower and we see an expansion to the upside, that right there is a lower time frame market maker buy model. And this occurs, of course, when we saw that expansion higher initially. However, the complete market maker buy model is simply the retracement followed by the expansion, but the overall structure is expansion, retracement, expansion. Or market runs higher, runs lower, continues to run higher. If we then take a look at the bearish example, we can see the following. Where the market ran lower, we can see an expansion to the downside take place. The market then retraces higher, trading into this bearish value gap right here. It forms a high and it then continues lower. What I want you to understand is that inside of this gray box, on the lower time frame, you will see a market maker sell model. You will see that there's sell-side liquidity that's being engineered by this run higher that can be attacked at a later point in time, because the higher time frame order flow is bearish and we are being drawn towards price level below the current market price. And until that price level gets reached, until that draw on liquidity gets reached, we are anticipating every single retracement higher like this to be simply the engineering of sell-side liquidity to be attacked at a later point in time by a expansion lower. Buy side of the curve, sell side of the curve. This is what we call a market maker sell model on the lower time frames, as we can see inside this gray box. Please take a screenshot of this chart as well and take proper notes. Because what we're now going to do is we're going to increase the level of difficulty of this lecture. We've begun rather easy and we're slowly building up to advanced theory. So therefore, you need to make sure that you understand this part before continuing. Let us now take a look at implementing time cycles with market maker models. Here we can see a schematic that represents time. We can see 3 time cycles. What is very important to understand is that during the current cycle, we refer to the high and low of the previous cycle or cycles to determine the order flow. If you want to listen to my full explanation of the concept of time cycles or PXH and PXL theory, I would highly advise you to watch my full lecture on the topic. So when we are taking a look at this current chart and we are seeing 3 different time cycles, the annotation already says that during the third cycle we refer to the high and low of the second and first cycles. When we understand that we look back in time to determine where key liquidity rests, and we understand that the market moves from, for example, an old low to an old high, or from an old high to an old low, we can anticipate key market reversals to occur. Because let's just imagine that we are bullish on the marketplace. Our higher time frame order flow is signaling to us that we're likely going to see higher prices. Our higher time frame bias is bullish. And we see that during the current time cycle, we take out the previous cycle's low. And we see signs that confirm to us that a reversal might occur. We can now anticipate the market to be drawn towards the previous cycle's high. And you might be wondering, cycle, what is a cycle? A previous cycle's high is relative to the time frame through which you're looking at the markets. And with time frame, I do not mean, oh, you're looking at the markets from a 1 minute or 2 minute or 10 minute or 15 minute or 30 minute time frame. No, I mean, what time window are you looking at? Are you looking at, let's say, a weekly window? Are you looking at a daily window? Are you looking at a session window? Are you looking at a 90-minute cycle window? Are you looking at a 30-minute cycle window, etc.? Those things are very important to understand when it comes to selecting what time cycles you're going to use. Because if you're only interested in the bias of the current session, then you would not, of course, be looking at, let's say, the daily cycle. You would much rather focus on the previous session's liquidity and or the 90-minute cycle's liquidity and everything below that. And that's why it's very important to choose a right time cycle. And the beauty about PXH and PXL theory, what I just described with you focally, is that what you put in within the X, so within this time, is subjective, and it's up to you to decide which cycle you're going to use. You can put in a previous 90-minute cycle, you can put in a previous session, you can put in, let's say, a previous day, or you can put in a previous week, a previous month, a previous year, whatever. If you study how these time cycles are being respected consistently and how the market moves from range lows to range highs or from range highs to range lows, you are going to see what I'm about to share with you. Here I have added 3 of the 4 sessions of the day within the schematic. As you can see, during the New York morning session, the sessions that we will be looking at are the London session and the Asia session. What we look at is their respective highs and lows. These levels need to be known to us. We need to either write them down or visually plot them on our charts, because IBDA will seek to refer back to those price levels as key liquidity pools. For the London session, these levels are crucial: the Asia high and the Asia low. Above the Asia high, we can anticipate a smart money reversal to occur if we're anticipating lower prices for the London session. If we're anticipating higher prices for the London session, we can anticipate a smart money reversal to take place below the Asia low. Therefore, for the London session, these are the most crucial reference points. You will see that during the morning and afternoon session, we have even smaller time cycles that we can look at. We can also implement the same time cycles for the London session. However, it's very important to note that the precision during the London session for especially the index futures, utilizing the 90-minute cycles that we subscribe to, is not as clean as, for example, the morning or the afternoon session. Therefore, I always tell my students to focus on the Asia high and Asia low, and even the previous day's afternoon session high and low, or the complete previous day's liquidity on the high and low for the London session. Let us take a look at the 90-minute cycles for the morning and afternoon session. These times are in New York time, and it is very important to note. First of all, the first 90-minute cycle of the morning session begins at 7 a.m. and lasts until 8:30 a.m. This is our accumulation window. This is also the latest sale for bullet time window that the inner circle trader Michael J. Huddleston provided. Must be random, right, that he gave that 90-minute time window as a time window in which we can look for very specific things to occur. The next 90-minute cycle then is from 8:30 a.m. till 10 a.m. This is our manipulation window. From 10 to 11:30 a.m. is the final 90-minute cycle of the morning session, and this is our distribution window. For the afternoon session, the first 90-minute cycle begins at 11:30 and lasts until 1 p.m. This is what I refer to as the lunch cycle. From 1 to 2:30 then is the second 90-minute cycle of the afternoon session. And then the third 90-minute cycle for the afternoon session is from 2:30 to 4 p.m. And you might be wondering, why are we specifically looking at these time windows? Why would we even want to use these time windows? As intraday traders, as traders that trade on the lower time frames throughout the sessions, it's very easy to get lost in all the price action. It's very easy to get lost in all of the candlesticks. Therefore, we need to find a way to objectify or analysis about the marketplace. And the way that we can do that in an easy manner is by referring to the highs and the lows that form during specific time windows. Because if the high, for example, gets taken out of, let's say, the 7 to 8:30 90-minute cycle during the second morning cycle, and we are anticipating lower prices for the day, we can anticipate a smart money reversal to occur above that 7 to 8:30 high. If we see those signs present that confirm to us that a smart money reversal is in, we can anticipate the market to draw towards the 7 to 830 low. This would of course be the same as if we would be looking at the markets during 1 to 2:30 p.m. and we were anticipating higher prices for the markets, and we would see the low of the launch cycle of 11:30 to 1 p.m. get taken out. Signs of a smart money reversal become present. Now we can anticipate the market to draw higher towards the high of the launch cycle. This is how we're objectifying our approach within the lower time frames throughout the sessions. First of all, we refer to the session's liquidity, the previous session's liquidity, but we can also refer to these 90-minute cycles as key highs and lows to look out for. If we would then take a look at the market maker buy model schematic again, but with some more lipstick, as you can see, I have first of all annotated that the previous cycle low was down here. The previous cycle high was the original consolidations high. The higher time frame order flow is bullish and we're anticipating higher prices. Then our new cycle opens up right here at this time. The market drops lower, taking out the previous cycle low, trading into our point of interest, and we begin to see the signs present that confirm to us that a smart money reversal is in. And you have heard me mention this a few times already now. Signs that confirm a smart money reversal is in. Well, let me explain a few signs that we can look for. First of all, we can be looking for SMT. We can be looking for a cracking correlation with highly correlated markets or highly inversely correlated markets. If that cracking correlation is taking place inside of our point of interest during the right time window, we can anticipate a smart money reversal to be in. When we then see this leg higher trading away from this point of interest, displacing to the upside, and we see the falling occur, where we see the market structure shift pattern take place, where we see this high right here get displaced above with speed and velocity, we can look for an imbalance that formed inside of this leg higher, and that imbalance is an opportunity for us to potentially see a retracement in, followed by an expansion higher. What I want you to understand is the following. This high is so important because it formed inside of a CB on the left side of the curve, a bearish fair value gap. Inside of this leg lower, there was a bearish fair value gap. Market retraced into that, formed a high, and it then expanded the lower, taking out this short-term low right here, taking out the previous cycle low, and trading into our point of interest. The moment that the market displaces above that high, it signals to us that the market has switched, or IBDA, the interbank price delivery algorithm, has switched from a sell program to a buy program. Now we can anticipate higher prices to be next. This is what I refer to as the market structure shift pattern, and it's in my opinion one of the strongest reversal patterns that we can see occur often. We then see the market draw higher, and it's drawn towards previous cycle's high because the higher time frame order flow is bullish and because we already took out the previous cycle's low. What we can see is that this upclose candle, the last upclose candle that forms before this final leg lower into a point of interest, into the previous cycle low, is what we refer to as a bullish breaker. So we're seeing multiple things line up right here that confirm to us that a low risk buy, which is the name of this retracement followed by an expansion, is taking place. Remember that CB, that bearish fair value gap that was here? If we extend it to the right, it is an inversion fair value gap. This high is important because it's set up that run lower. Therefore, the upclose candle that formed right before the final leg lower is what we refer to as a bullish breaker. And a fair value gap will form inside of this displacement leg higher. That's a BC. What we're seeing there is that we're seeing true resistance turn support. And your true resistance turn support is valid when these things occur. It's not randomly, oh, any high or any random high that gets broken through, it should now begin to function as support. No, the high should function as support when all these things are aligned, when the framework is present. And that's why market maker models give you a framework to look in for specific patterns to occur. This is also known as a balanced price range, by the way, and that's why the market is allowed to expand higher. This is a market maker buy model utilizing the logic of PXL to PXH, a move from the previous cycle low to the previous cycle high because we were anticipating higher prices to be next. If we then take a look at the market maker sell model with the same logic, we can see the following. First of all, we can see that an original consolidation took place right here. This is where our previous cycle low formed. The market ran up higher and then this key time came along. The market manipulated above the previous cycle high, which was resting around this price level right here, and it traded into our point of interest. We then see the market begin to displace to the downside, trading below this low. This low is so important because it formed inside of a bullish fair value gap, a BC, right here on the left side of the curve, and this low set up the run higher into the previous cycle high, into our point of interest, where we're seeing those signs confirm to us that a smart money reversal is likely to take place. Market displaces to the downside. This is our 2022 model short entry right here, where we see an imbalance form after we see displacement below this low. The market retraces into that low, into that imbalance, into that BC right here, and it continues to the downside, drawing towards sell side liquidity. It's important to note that this occurs when our higher time frame order flow, our higher time frame bias is bearish. If we then take a look at the last down close candle that formed before this final leg higher, we can annotate that as our bearish breaker. This bearish breaker is again very important, and it's a very important reference point to look out for when the market displaces below it within this structure, within this framework. This is where true support turns resistance works. Support and resistance works, but only sometimes. Think about that for a second. You hear me as an ICT trader say support and resistance works, but only sometimes. And the majority of the times where your support turns resistance ideas work is when this structure is in play and where you see an imbalance displaced below the low. That's a gem for you to investigate. And are you also noticing then that if you understand how to apply this framework, how to look for these specific things, you can basically have one of the most simplistic entry patterns ever. And even one of the most simplistic understandings of algorithmic price delivery. And I know that right now, if you're completely new, this probably sounds like Spanish. You're hearing me speak and you're like, what is he talking about? All these words, all this terminology, what is this? Trust me, just submit the time. Give it some time to process, think about what I'm saying, and try to look for it in the charts. Don't trade it, just go into historical market data and look for the things that I'm sharing with you right now and see whether or not you're seeing them repeat. And if you are seeing them repeat, you are experiencing a light bulb moment. And it's one of the most beautiful experiences that you can have during this journey. So let us now take a look at the application of time and market maker models. I would never create a lecture on YouTube without being able to showcase that I'm able to apply what I'm teaching you live inside of real market environments. The majority of educators nowadays online only do stuff in hindsight. They go out there and they go into bar replay and they show, look, this is when it happened. This is where it worked. This is where this pattern, this theory was applicable. But you never see them do it live. You never see them call the right side of the chart. That place where it's empty, where there are no candlesticks. And you need to really think then, why aren't they doing that if they're sharing those theories with you? I think that's enough said. Let's begin with taking a look at real-time executions that I took, and I will walk you through the internal dialogue based on what I just shared with you. Let's begin. Alright, so here we are at the first execution that we're going to break down, utilizing the logic that I described to you so far during this lecture. What I'm going to do, first of all, is I'm going to play back these videos. I'm going to play back them in a speed that's rather slow. And before we begin this recording, let us first take a look at the following. What we're going to take a look at is how the market delivered thus far until this point. Don't just look at the entry. You need to look at how I recognize that this was likely the smart money reversal right here. Pay close attention, because what you need to understand is the following. When we're seeing this low right here get taken out, it's very important. And the reason why that low is very important is due to the fact that it's the low of a fractal 30-minute cycle. And you're probably like, what? Fractal 30-minute cycle? What are you on about? I can already hear you thinking. Okay, let me explain. I described earlier during this lecture to you the 90-minute cycles that we have. And the first 90-minute cycle for the afternoon session is 11:30 to 1 p.m. If we divide that 90-minute cycle in 3, or by 3 I should say, we get 11:30 to 12, 12 to 12:30, and 12:30 to 1. If we pay attention to the low of 12 to 12:30, we can see that it formed right here. This was the low of 12 p.m. to 12:30 p.m. Then between 12:30 to 1 p.m. we took out that low right here and we displaced to the upside. This BC was present, and notice that this BC functioned as support on price during the second 90-minute cycle of the afternoon session, after the 1 p.m. opening, of course. We then see the market react perfectly at 1:11 p.m. and we begin to see the market displace higher. Market displays above this upclose candle, function as support on price right here. This gap is a breakaway gap and should not get traded into again. I want to see this BC remain open. I do not want to see the market reprice into the low of that BC and then continue higher. That's how I manage this position when it comes to the stop loss as well. Maybe 0.5% is a bit too slow, so let's just use normal speed. What I want you to understand is that what I just described to you is everything that confirmed to me that the order flow was bullish and that we were likely to anticipate higher prices for this part of the afternoon session. Previous cycle high rests above here, buy side liquidity, and we have buy side liquidity resting at this price level. This is where we're seeing time distortion take place, where the market is consolidating, going sideways, and we're waiting for the right time to come for the market to expand. And here we're seeing that expansion begin, where we're beginning to see those big upclose candles. For your info, this video has been up on my YouTube channel for a while now. This was the 25th of March. And as you can see, this is real-time market data. This is real time that the candles are printing. This is not hindsight bullshit. There we can see that the first buy side liquidity pool gets reached, and now we're breaking through it. What I'm doing is I'm monitoring to see how the market is reacting off this buy side liquidity pool, because again, it's a crucial price level. Notice that we formed an imbalance right here. As you can see me annotate as well in the live recording. BC, and it should now begin to expand to the upside soon. My stop is trailed below the BC. If it doesn't expand right now, I know I need to get out and I need to wait for more. The next trade that we're going to break down is a market maker sell model that I took after the FOMC release. For this analysis, it is very important to understand the following. First of all, it is very important to understand that FOMC is usually a two-stage delivery event where we have our first manipulation cycle begin at 2 p.m. and our second manipulation cycle begin at 2:30 p.m. What we see is that at 2:30 p.m. the market drops lower right here, forms a low, and it then begins to run higher, already taking out previous cycles liquidity. What we begin to see then is that the market runs higher aggressively, explosively, into a very specific time-based price level where that was taking place. Something for you to investigate on your own. At exactly 3 p.m., the market ran up higher right here, and at 3:02 we formed a high and we began to disrespect this BC on the left side of the curve. This BC began to function as an inversion value gap on price. The market then distorted time, went sideways, until it was allowed to displace lower, trading below this upclose candle, with multiple imbalances right here. Market retraces into those imbalances and it forms a high at exactly the right time and it begins to run lower. What I want you to note is that because this expansion was so aggressive and we already traded early on in this cycle above the previous cycle's high, we need to fractalize our cycles again. Just like we did in the previous example, we're now going to fractalize the cycles during the final 90-minute cycle of the afternoon session, where the first 30-minute cycle is from 2:30 p.m. to 3 p.m. What we see is that at exactly 3 p.m. the market opens up and takes out that previous 30-minute cycle's high, meaning we're in a premium right now. And because we are in a premium and this is our reference point combined with time, plus we have seen this very aggressive run higher, we can anticipate that a lot of sell-side liquidity has been engineered because the majority of traders will try to chase this leg higher because they think the market is mooning. We need to get long. We need to get in right now because else we're going to miss out. Else we're going to miss out on this beautiful run higher, etc. We of course know that the opposite is true and that sell-side liquidity is being engineered that can be attacked. So what we see is that the market forms a high in this area and I wanted to see speed and velocity below this low right here. Markets begins to trade below that low, and that's where we're beginning to see the market accelerate. That's at least what I want to see. I want to see those big down close candles that confirm to me that I'm on side. Notice that on the right again, the time is sprinting along, which is showcasing to you that this was all done in real time, real market data, no replay bullshit, no hindsight bullshit. This is simply me showcasing my screen whilst the market is delivering. And notice how every single annotation holds value. Every single annotation is a crucial reference point for IPDA. The level that I'm now monitoring is this horizontal line, or here, this horizontal dotted line right here. And that will be a price level where I will take a partial. Market begins to expand lower. And we're seeing the signs that confirm to us that we're in fact inside of a sell program and that we're in fact likely to draw lower towards sell-side liquidity. There we see again beautiful big down close candles, and now I'm monitoring to see whether or not price will find resistance at this price level or this place below it. I already took a partial here because that opening price of that final 90-minute cycle is a crucial reference point. This is where you can see the executions of this trade, by the way. Now I'm monitoring to see if this CB right here will function as resistance from price. If that CB will function as resistance from price, I'm anticipating that the market will draw towards a new low for this current 90-minute cycle before the market close. Market is still hanging around that opening price. It's just going up and down. And as long as price doesn't displace above that blue box, above that CB, I'm anticipating lower prices. The moment that price would displace above that CB, it would mean I would get out of my position because the sell program was likely going to be invalidated then. What do we see then? We begin to see the market still find resistance inside of that blue box. With the final 10 minutes of the day coming on now, we can anticipate big down close candles as long as price doesn't displace above that CB. This is again time distortion that's taking place for your info. And here we're beginning to see the market beautifully deliver lower towards that final strong liquidity. Every single premium ray functioned as resistance during this sell-off, and that's exactly what you want to see when you're anticipating lower prices. And there the target gets delivered. And what I'm going to do now is I'm going to pause this recording for a moment. And what I want to discuss with you is the following. I know that some of you are probably watching this recording so far and you're probably like, this guy must be sharing bullshit. This must be all just one big hoax. That there's probably not any validity behind the things that he's sharing. Well, what I want you to see is the following. Here we have the time window that I shared with you. 2:30 p.m. to 4 p.m. being the final 90-minute cycle of the afternoon session. Even of the day. Yes. You tell me that this delivery right here is random, where we see a complete market maker sell model occur within that 90-minute cycle window. Original consolidation right here. Buy side of the curve, reversal occurring during the right time, at the right price, sell side of the curve. This right there here is beautiful. This is algorithmic precision, and it's absolutely undeniable. And once you start seeing this for yourself, when you go into historical market data and you begin looking for the things that I shared with you thus far during this lecture, you will feel a sense of appreciation for this precision that words can't really describe. And it's what I refer to as a light bulb moment. It's that moment where you experience something that you know of, damn, this will change everything. And once you experience those moments, it's very important that you journal them as best as possible. So please do so. Don't be reluctant, just do it. Because trust me, in due time, once you proceed and once you pursue this journey more, you will be able to look back at those moments and be so grateful for the fact that you experienced them back then. And I personally have a rather large journal with all my findings annotated, with everything that I discovered outlined, everything that made sense when my mentor, the inner circle trader, discussed and shared those things, or when he hinted at very specific things and things began to click. And now that I look back at all those moments, I'm just very grateful that I journaled them back then. So that's something I would kindly advise every one of you to try and do as well as best as possible, because your future self will thank you, and keep that in mind. No matter how hard it might be right now, I don't know where you're at. You might be completely new to this journey. You might already be going after it for a few years and it doesn't seem to work just yet. What I want to share with you is that as long as you don't throw in the towel, you will be able to make it. You just gotta submit to a bit more time. just a little bit more. Just consistently try to improve every single day. Try to improve based on the things that you know you need to improve upon. Are your technicals off? Is your confidence off behind the charts? Why? Is it because you, let's say, don't have a clear model? Is it because you don't have clear rules? Is it because your model is too subjective? Is it because you lose objectivity? Here, during this lecture, I literally taught you how you can objectify the majority of your trading. Time-based POIs and time-based rules. But some of you are already able to objectify your own approach, your own model, and that's wonderful. That's great. Now it's up to you to hold that self-control, to only stick to your model and not try to do more than your model requires you to do. And I know it can be challenging, I know it can be tough. However, you need to understand that taking one good trade a day on a demo account, of course, because I cannot tell you to go out there and trade. That's something you would have to decide for yourself. I'm not a financial advisor, as of course was already outlined prior during this review when my risk disclaimer was shown. But just understand that if one could just take one good trade a day or one good trade a session, that's more than enough. And you don't need more. So don't try to overdo it. A short rant in here. Sometimes I let these rants come in. My mentorship students know this as well. And I try to stay on topic the majority of the times. However, I feel like it is very important to sometimes share this type of passion because I know that it can really help someone that might be struggling right now and that might be going through some shit right now. To then hear someone shed some light on their situation and to tell them that things will get better is just a wonderful thing. It's just beautiful. And I really hope that by me sharing this, it helps. But let's continue to the final example of this lecture. The third live trade breakdown. The final trade that we're going to break down is a long that I took on the 3rd of May 2024, where I went long at this price level right here, anticipating the market to draw towards this buy side liquidity here. I'm just going to pause the recording here. I apologize for our faces, the faces of the podcast host and mine, the back of my face of course, but the podcast host and mine are of course on it because I made a fancy edit. But I was anticipating the market to draw towards this buy side liquidity here. This was my original consolidation. Due to the falling. We were currently in the final AM cycle, and I saw this high right here form when I knew that the market was likely to be repriced higher because my final drawn liquidity in my mind was the 18,000 price level right here, which is a very important price level. And if you would study that price level for the past few months, you would see repeating phenomena there. However, because I was anticipating the market to draw higher towards that price level, I was looking for longs. And when I saw the low form at exactly 11 or 10 minutes past 11, and I began to see signs of a reversal being in, intermarket relationship was signaling it, the right time of reversal, POI was reached, etc. Displacement to the upside, all those things were aligned, so therefore I was anticipating higher prices to come. Let me just speed up the video properly. As you can see, I pyramided inside of this BC right here. I allowed for this lower BC to get traded into as well when it comes to the stop. And here you can see me type big green candles and what occurs, big down goes candles. Does that matter to me? No, because I'm not simply looking at these candles and letting those candles influence me. What I look for is a structure. What's the framework that we're currently operating in? And when I understand that we're likely to draw towards that buy side liquidity, based on everything that occurred on the left side of where we're currently at, I know that we're likely to draw higher than when the time and price are aligned. So all I need to wait for is the signs that confirm to me that we're not displacing in the opposing direction of my anticipated analysis. Both imbalances are annotated, and as long as price doesn't displace below them, I'm anticipating higher prices or big green candles to come. Zoomed out on the 1 minute chart, you can see that the price level that I was aiming for, this CB, formed right here. And notice that a high was engineered right below that. When you see that occur, when you see such a clear high or low that's time-based form before an imbalance, that's just very sweet drawn liquidity in my opinion. And you might be wondering, why is that high time-based? Pay attention again to the cycles fractalized by 3. Final AM cycle divided by 3 gives us 10 to 10:30, 10:30 to 11, and 11 to 11:30. This high formed between 10:30 to 11. We're now trading inside of 11 to 11:30. Notice how every single discount array is functioning as support on price. Imbalance is right here, imbalance here. Price is repricing lower into this downclose candle, offering smart money the opportunity to buy in a discount before it's likely to expand soon. Notice what I'm annotating live right here. Notice that I'm putting a smiley below big green candles incoming, because I know that big green candles are likely to come right now. Look what occurs. Again, real-time market data, no replay bullshit, no hindsight bullshit. This is the right side of the chart, the place where there's no delivery being anticipated. This CB will function as a future inversion value gap on price, a future basically support zone, if you would like to clarify it in a simple manner. Took a partial inside of the close of the downclose candle right there. Market found some resistance there. And as long as price stays below that price level, I'm not anticipating that final run. However, the moment that we begin to see a clear displacement above that price level, I'm anticipating that the final target will get reached. ES took out the high whilst Nasdaq did not yet. This is important because this is a form of SMT that can take place between cycles, where if one of the index futures, or for example if EU and GU, would not be in sync when it comes to where they are at relative to the time-based liquidity, the time-based liquidity being of course the previous cycle high in this case, where ES already took out that high and Nasdaq did not. That's a sign to be aware of, because it could signal that we might see a reversal occur. Little gem for those of you that managed to stick all the way to the end. There are multiple forms of SMT. You have the regular cracking correlation at the lows or highs, and you have a cracking correlation that occurs relative to the time-based liquidity. And there are even more forms of SMT that we can look at. Here you can see me put on the executions. Now the market displaced clearly above that red line right here with this upclose candle. Notice that that upclose candle formed the high right before that price level. So now I'm anticipating the final drawn liquidity to get reached very soon. Time distortion is taking place, consolidation. Consolidation always leads to expansion. And there we see the final target gets reached. With that, this lecture comes to an end. I hope that you found it insightful. I hope that you were able to learn something from it. I hope that you were able to experience some light bulb moments. I know it was a long one. I'm not too sure what the exact duration was. I know at least that I shared as many value bombs as possible. I ranted a lot. I spoke a lot. However, if you would closely listen to the words used and you would pay attention to when those words were used, you are likely to see things that you are not aware of just yet. I hope that you found this lecture insightful. I look forward to speaking with you in a new one. Please let me know if you appreciate this type of content. If you do, please leave a comment. I would highly appreciate it. Be sure to leave a like as well. And if the response is good, I will continue to make this type of content going forward. I want to wish you all the best. Please be safe. And I look forward to catching up with you in the next one. Be safe.